Hi everyone, welcome back to Diamond NestEgg. I'm Jennifer, personal finance educator and money expert. For those of you new to Diamond NestEgg, I work with small and medium-sized businesses to teach and improve employee financial literacy and wellness. Today, I'm here to talk to you about Roth IRA withdrawals, limits, and penalties. Something that many clients have been asking a lot about recently as they think about other ways to possibly make ends meet, given the current economic uncertainty. By the end of this video, you'll know what you can take out of your Roth tax-free and penalty-free, as well as what you can take out of your Roth, but you'll have to pay penalties and or taxes on. We'll also be giving you a chart that you can easily refer back to see which situation best applies to you. So, a Roth IRA is a special retirement savings account where you pay taxes now so you don't have to pay them later. So basically, you pay into your account with after-tax money or money that you've already paid taxes on. Everything in your Roth IRA grows tax-free, and all future withdrawals are also tax-free. Roth IRAs are generally used by our younger clients, recent grads, and those that think their taxes will be higher in retirement than they are right now. If you're interested in learning more about saving, investing, insurance, or retirement, hit that subscribe button. We're here every Sunday with a brand new video about your money and how you can make the most of it. Roth IRAs generally have more flexible withdrawal rules than traditional IRAs and 401ks. But do your homework before making any Roth IRA withdrawals. If you don't meet certain requirements, you could end up owing taxes and a 10% early withdrawal penalty. Do you have a Roth IRA? Drop us a comment below and let us know. Moving on to Roth IRA withdrawal rules. Roth IRA withdrawal rules differ depending on whether you take out your contributions or your earnings. Contributions are the money you put into your Roth, and earnings are the profits you make from the funds and investments in your Roth. Both contributions and earnings grow tax-free in your account. That's why it's so awesome. Let's talk about contributions first. You can withdraw your Roth IRA contributions at any time for any reason with no tax or penalties because you already paid taxes on that money when you put it into your Roth. For 2021, the annual contribution limit for both Roth and traditional IRAs is $6,000. If you're age 50 or over, you can make an annual catch-up contribution of $1,000. Please note though, contributions can be reduced based on your income level. For 2021, if your modified adjusted gross income is less than $125,000 as a single filer, you can contribute the full amount of $6,000 to your Roth. If your modified adjusted gross income is between $125,000 and $140,000, your contribution will be reduced. And if your modified adjusted gross income is $140,000 or more, you don't even qualify for a Roth. And if you're married filing jointly, you can contribute the full amount of $6,000 if your modified adjusted gross income is less than $198,000. If your modified adjusted gross income is between $198,000 and $208,000, your contribution will be reduced. And again, if your modified adjusted gross income is $208,000 or more, you can't even have a Roth. I've included links below if you want more details on modified adjusted gross income and Roth IRA income limits for 2021. For those of you that don't qualify for a Roth, you can check out our video over here. It goes through a Roth versus traditional 401k and IRA. Check it out and see what other retirement options might be available to you. Traditional IRAs don't have any income limits, but there are income limits on the amount of contributions that are tax deductible. So far, we've talked about Roth contributions, the money you put into your Roth, and the fact that contributions can be withdrawn at any time for any reason with no tax or early withdrawal penalties. because you've already paid taxes on that money when you put it into your Roth. Withdrawals on earnings, on the other hand, work differently. These distributions could be subject to income taxes and a 10% penalty, depending on your age and how long you've had the account, which brings us to the Roth IRA 5-year rule. Generally speaking, you can withdraw your earnings without owing taxes or penalties if you meet these criteria. 1, you're at least 59 and a half years old. And 2, it's been at least 5 years since you first contributed to any Roth IRA. This is known as the 5-year rule. The 5-year rule applies regardless of your age when you open the account. So for example, if you open your Roth and make your first contribution at age 56, you still have to wait 5 years until you turn age 61 to avoid any taxes. The clock starts ticking on January 1st of the year that you first contribute to any Roth. Now, because you have until April 15th of the following tax year to make a contribution, your 5 years might not be a full 5 calendar years. Again, let's take an example. If you make your first contribution to your Roth in early April 2021, that's before April 15th, the tax deadline, but you designate it for the 2020 tax year, and yes, you can do this, you'll only have to wait until January 1st, 2025, not January 1st, 2026, to withdraw your Roth earnings tax-free, assuming you're at least 59 and a half years old. With Roth IRA conversions, the 5-year clock starts ticking on January 1st of the year you make the conversion. A Roth conversion is when you take all or part of the balance of any existing traditional IRA and move it into a Roth IRA. And if you inherit a Roth IRA, the clock starts ticking when the original owner made their first contribution, not when the account is passed on to you. So if you withdraw earnings from your Roth IRA, the withdrawal is tax-free and penalty-free, what the Internal Revenue Service calls a qualified distribution, so long as your Roth meets this 5-year rule and one of the following circumstances applies to you. 1, you make the withdrawal at age 59 and a half or older. 2, you withdraw funds because you are permanently disabled. 3, the withdrawal is made by a beneficiary or your estate after your death. Or 4, you use the withdrawal to purchase, build, or rebuild a first home for yourself or a qualified family member. Qualified family members include your spouse, your children, grandchildren, parents, or other ancestors. For this withdrawal, there is a lifetime cap of $10,000. We'll talk a bit more about this later in the video. Again, this type of withdrawal of earnings from your Roth that are tax-free and penalty-free are called qualified distributions. Now, we're going to talk about non-qualified distributions. Very simply stated, non-qualified distributions are any withdrawals that aren't qualified distributions. You'll pay taxes at your ordinary income tax rate on earnings plus an additional 10% penalty. However, there are certain circumstances when you may not have to pay the 10% penalty, and we'll talk in detail about the 2 most common ones. The first is the first-time homebuyer exception, and the second is for qualified higher education expenses. Let's dive into the first-time homebuyer exception first. But before we do this, if you're enjoying our video, show us some love, give us a thumbs up, and smash that subscribe button. It really helps with the YouTube algorithm, moves our video up the charts, and helps get this great wealth building information out to as many people as possible. So, the first-time homebuyer exception. You can take money out of your Roth without paying a penalty if you are a first-time homebuyer. The Internal Revenue Service categorizes you as a first-time homebuyer if you and your spouse, if you have one, haven't owned a home ever before, or if you and your spouse, again, if you have one, haven't owned a home during the prior 2 years. If you meet the 5-year rule, you can avoid taxes altogether on your withdrawal. If you don't meet the 5-year rule, you'll pay income taxes on the earnings portion of your withdrawal. Money comes out of your Roth in the following order. Contributions come out first, then comes the money that converted from another account, such as a traditional IRA or 401k. Earnings come out last. The maximum amount you can withdraw for this purpose is $10,000, and it's a one-time deal for most folks. Once you make this withdrawal, you have 120 days to use it to buy, build, or rebuild a home for yourself or a qualified family member. And again, qualified family members include your spouse, your children, your grandchildren, parents, or other ancestors. Other than buying a first home, another common reason for tapping into a Roth is for qualified higher education expenses. You can take penalty-free withdrawals from your Roth IRA to pay for higher education expenses at a college, university, vocational school, or other post-secondary educational institution. But you'll still be responsible for income taxes on the earnings portion. Qualified expenses include tuition, fees, books, supplies, required equipment, and room and board if you're at least a half-time student. You can use the distribution for yourself or to help out your spouse, children, grandkids, or great-grandkids. Just keep in mind that the withdrawal cannot exceed your higher education expenses for the year. You should also know that Roths and other retirement accounts are not counted as assets on FAFSA, the free application for student aid. But withdrawals do count as income. What this means is that you could receive less financial aid if you use your Roth to pay for higher education expenses. Here are some other situations when you may not have to pay the 10% withdrawal penalty on non-qualified distributions. 1, you have unreimbursed medical expenses that exceed 10% of your adjusted gross income. 2, you need to cover medical insurance premiums after a job loss. 3, you're paying for childbirth or adoption expenses. This amount is capped at $5,000. 4, you owe the IRS money and the distribution is due to an IRS levy. 5, you need the money for qualified disaster recovery. 6, you're a member of the military reserve and taking qualified reservist distributions. And 7, you're taking a series of substantially equal periodic payments. If this is what you are thinking about, consider working with a tax professional. Substantially equal periodic payments are somewhat complicated, and there is little guidance available from the IRS. And remember, even if you don't have to pay the 10% withdrawal penalty, you will have to pay taxes at your ordinary income tax rate on earnings. We know this can be a complicated topic, so if you have any questions, shoot us an email at hello@diamondnestegg.com to see if we can help, or consult your tax advisor for more details. Now comes the million-dollar question. You can take a withdrawal, but should you? If money is tight or you think that it might be tight at some point in the near future, a withdrawal from your Roth may seem like an easy solution, but if you can find another way to make ends meet, you really should. For example, if you have an HSA, a health savings account, you could use that to cover your medical expenses instead of dipping into your Roth. Take a look at this video here. You can learn more about health savings accounts, why many are referring to this as their secret retirement tool, and why you should probably consider having one if this is an option available to you. The other thing you can and should do first is to dip into your emergency fund, if you have one. That's what it's there for, emergencies. To learn more about emergency funds, check out our playlist over here. We go through how to start saving for an emergency fund, how much you should have in there as well, and where to keep your emergency fund, and why you shouldn't keep it in your Roth, which some folks are tempted to do. Roth withdrawals should really only be considered as a last resort, not because you can avoid any potential taxes and penalties, but most importantly, because you can keep your retirement savings untouched and stay on track to reach your retirement goals. Once you take money out of your Roth, once you withdraw that money, you can't repay it and put it back in. This is not a loan. In fact, the primary reason for not taking an early withdrawal is that the money you take out of your Roth and any potential earnings that you could have made from it are gone forever. You could miss out on years or even decades of tax-free earnings and growth, depending on your age. We created this chart for you so that you can have a quick, clear overview of the Roth withdrawal rules all in one place. Feel free to refer back to this as you need, or if you'd like a hard copy, just shoot us an email at hello@diamondnestegg.com. I've included our email below this video. All right, guys, thanks for watching. We hope you enjoyed this video and learned a ton. If you did, don't forget to give us a thumbs up and subscribe to our channel. Everyone's financial journey is different, and we'll do our best to educate you so that your journey is as smooth and stress-free as can be. Many of us set goals for the new year, and getting financially on track is nearly always on the top of the list. So join us again next week with another video about your money. In the meantime, check out our other money saving, wealth building videos on this channel, or shoot us an email if you have any questions.